Hello, everybody. Welcome back. So this is the last part of the series of videos where I'm analyzing Bajaj Auto. So till now, we have looked at the business, how it makes money. What are the critical parts of the business. We looked at the management discussion and analysis, like why the sales went down, and did a little bit digging there, and the currency risk for their exports. Then we also looked at their balance sheet and income statement and cash flow statements, and how it they look they generate cash and the free cash flow, and looked at the segment info. We looked at their tax details, and all the important footnotes. So we kind of pretty much have a good idea of the business and the main parts. So now, what are the next steps? So now the ball is in your court. So the next steps for you. Okay, so as now you've looked at all the videos and you know about the business, you need to get these line items in order to value the business. Okay, so here again I'm giving you guidelines. So first thing what you have to do always is figure out the growth rate, and that too you have to figure out. You have to kind of have an estimate of growth rate in domestic sales versus export sales, because they can vary, right? But again, you don't have to go too crazy. Just have a rough estimate, like, is it going to vary a lot? Here again, you have to use your what you can say is like you know uh, uh, your business acumen, what they call. So this is something you can never learn in a school or something. It just comes, by analyzing businesses. Like, what are the chances of their growth? Let's say here versus Sri Lanka. You know, so that you'll have to figure out, based on your business acumen. Then the second thing what you'll have to figure out is the growth rate of the selling price per vehicle for each category. So this is pretty important. The reason I'm trying to say each category is, like, in the first video I showed you, they have two main components, right? The two-wheelers and three-wheelers. So now the thing is, in their annual report, nowhere they have mentioned what was the breakup of the sales between two-wheelers and three-wheelers, right? But they did show how many they sold. So if you look at it here, just again to give to recap. So here you can see all those details, right? What were the domestic sales versus exports of motorcycles, and they call this as commercial sales here. And what was their breakup between motorcycles and commercial vehicles? So commercial vehicles are the three wheelers. So now, based on this, you can do a little trick. What you can do is, maybe just Google and figure out what's the average selling price of a three wheeler. Okay, so I'm just making it up. Let's say average selling price is of a three wheeler is X. Okay, X rupees, and the average selling price of a two wheeler is, let's say, 0.7x. Now what you have to do is you have to equate like that. You have to break up the selling price, average selling price, in such a way that that will be the ratio. Now I'll tell you why you have to do it. So if the difference is not a lot, let's say the average selling price of two wheeler and three wheeler is almost the same, then you don't have to, really go crazy around figuring out. But if the difference is at least more than 20%, you have to do is, because you remember at the first video also I explained you the business dynamics of two wheeler and three wheeler are totally different, and their growth rates will be different, their their evaluations will be different. So when there are so much differences, it's better to value both of them separately. So as you're valuing both of them separately, and if their average selling prices are different, you need to figure out the at least the ratio. That way you will be able to value, like, more like, you can say, it will be more meaningful. Your value will have more known factors than unknown. Okay, so these two things, now based on these two things, you'll be able to figure out overall what will be the uh, at least the rough growth of the sales of the company. Then you also have to figure out the future operating margin. Again, try to separate the estimate between two-wheelers and three-wheelers, but like if the manufacturing expense is pretty much the same, and as we don't have that information, you might just take a single figure and deal with it. Then you definitely have to factor into the currency risk of the international business, because there were huge exports, right? So you have to look at it that way, and you have to see. So here you can see, like, out of 24,000 crores, almost 16,400 crores was because of India, and other was rest of the world. So you'll have to kind of really factor into the currency risk. Then the future capital expenditures, in this case, they've been pretty stable, but you can be a little bit because there can be technological changes. They might have to upgrade their factories in a more it might be more expensive. So you can kind of be conservative, but this shouldn't make that much difference because this is not a capital intensive business. Then the future excise duty rate, this we already had a talk that it does change, and you have to be conservative. Don't, because this year it was less, don't assume in future all the time it will be less. Future tax rate we considered 34%. You can just go with that. Now, based on this, you can figure out the fair value of all assets, and also you have to figure out fair values of assets and liabilities. Or here in their balance sheet, looking at that, that shouldn't be that big of a deal because their balance sheet is pretty simple, right? So here, let's look at it again. There is no any line item where you might have to kind of go, and they don't have contingent liabilities. Contingent liabilities means liabilities that is not shown in the balance sheet, but it's off balance sheet. They don't have anything like that big. Like the way in Hero Motors, we had to consider the Hero Finance's assets, liabilities, and all those things. So, like risk-wise, you can pretty much consider the same, but maybe you might have to go back and look at the loans they have. Sorry, no, not the loans. Here in their liabilities section, you if you find anything like in the financial liabilities, maybe you can go and look at it again and get a fair value. But overall, you should be able to take the figures that are given in the balance sheet and plug them in. And when you have all this with the approximate discount rate, you will be able to use the discounted cash flow model, and you'll be able to get like a rough uh, range of value, of the whole business. Which again, if you divide it with the total shares outstanding, you should be able to get the fair value of the stock. So again, if you are looking for a source for investment valuation technique, you're not familiar with discounted cash flow, I would definitely recommend you to read the investment valuation by Damodaran. I've found it very useful. It's really valuable. And in the first section, he's explained about discounted cash flow. It shouldn't be, maybe in about you will need to spend about 10 to 12 hours, and you'll be able to understand the concepts and figure out yourself then the discounted cash flow, and then the total value. So that's it all about the valuation. Now let's come to the closing remarks. Okay. So here I always instruct anyone where I'm lecturing that valuation. Do not try to compare your valuation with any other person's valuation. Neither ask anyone else as to what they think is the value of the stock. Because the truth is that there is no right answer for estimating a fair value of a stock. It all depends on the growth rates you assume, right? So if I assume 10% growth rate, it will come out something. The other person assumes 30% growth rate, it will come out something else. We both can be right. It's only the future will tell who is right or who is wrong. So right now both can be right. So do not compare. It's like a futile exercise. I see people doing all the time. In fact, what that makes is that makes your effort you are not valuing your own effort. That means you're losing confidence in yourself. Then the whole valuation exercise becomes a joke, because then you just jump in and you do what other people are doing. Then why even spend time doing all this, right? So do not compare. Now the second thing what I always do is talk about is stock tips. So here just a little this thing. No one in this world has become a successful investor by following stock tips. Their success has been based on their own research and judgment. Thus, if you want to be a successful in your investment, you would have to follow the same. That is, say no to stock tips and make sure your investment decisions based on your own research and judgment. So always remember that, it's like you are spending all this time, you're figuring out, so you have to value your own judgment. Do not second guess. Do not, say, oh, maybe I saw that in the television, you know, there. So all that is going on. You have to literally make yourself totally soundproof to the external noise. You just have to go with your own decision. That's the only way you will be able to, make sound investment decisions. So that's it from my side. I hope you found the series useful. Please put your comments. If you have any questions, I'll try to answer them. And I wish you all the best in your investment journey. Thank you.